In general, we like to say that markets are pretty efficient, that investors as a whole are good at taking new information that appears, like this, and applying it to the price of a stock, like this. Markets are usually quite good at doing this quickly and in a way that means most stocks are always trading at their fair value. The first person to coin the efficient market hypothesis, Eugene Farmer, puts it simply: markets are efficient if they reflect all available information. There are, however, times when this isn't the case, where information is released and something nonsensical happens to the price of the associated asset. When this happens, we say that markets are inefficient. They are not pricing stocks or assets according to their true fundamental value. The CUBA incident is one such example. In 1994, Hersfield Advisors launched the Caribbean Basin Fund. The fund was listed on the Nasdaq exchange as a closed-ended mutual fund with the ticker CUBA. A mutual fund pools investors' money and buys multiple stocks. Each mutual fund unit then has a price, which is meant to reflect the weighted average underlying value of all of the fund's physical holdings. This underlying value is called a net asset value, or NAV. The CUBA fund held approximately 70% of its assets in US-based companies, with the remaining securities being from other countries, primarily Mexico. Aside from this, the fund held smaller investments in pre-Castro Republic of Cuba bonds and shares in the Cuban Electric Company, all with the value of $0. It's important to stress that the fund had no direct investment in the country of Cuba, despite its identifying ticker. This is important because when Obama announced intentions to relax diplomatic relations with Cuba in 2014, something interesting happened. The price of the CUBA fund rose by over 107% over 6 days, and the actual value of the fund? It rose only 6% over that same period. Because the number of units available in closed-ended funds is fixed, the price of CUBA was able to decouple from its actual intrinsic value. Volume in the fund spiked, pushing its price above the NAV. As behavioral economist Richard Thaler puts it,
"This is just a mistake."
Economists like Thaler use anecdotes like the CUBA incident to demonstrate that markets are not always efficient. Markets took a piece of information, Obama's diplomatic policy on Cuba, and misinterpreted it by applying the information to a fund with no holdings in Cuba. History is scattered with these anecdotes. Behavioral economists argue that when these anomalies happen on a large scale, there is the opportunity for bubbles to appear. A bubble occurs when the price of an asset becomes inflated to a point where it rapidly outgrows its fundamental value. However, it's difficult to prove that these bubbles exist on a broader scale, because in most cases, the fundamental value of something isn't any set number. Price is often the best indicator we have of asset value, and when price and value decouple, it's not always obvious to see. For this reason, the debate continues to rage within the financial community. Are markets efficient? Comment your thoughts below. Thanks for watching this video, and we'll see you next time.